assuming you have traded stock before, you've probably dealt with the bid-ask spread. Now that we're trading options, we're going to deal with a little more complexity in this bid-ask spread. And specifically, that is that the bid-ask spread changes drastically as you change your strike price and as you change your expiration date. Generally, the bid-ask spread is going to be tighter for options that have higher volume. And options that have higher volume also are on underlying stocks of high volume. You'll see that the SPY has almost negligible bid-ask spreads, especially the weeklies, and especially near at the money. So let's say you have an option you want to buy, and now you have to place your bid to buy it. This is not a problem for the SPY, because the bid-ask spread is only 1 or 2 pennies. You can simply buy with a market order, and you won't lose any money. But let's say you're trading something less liquid. I'm planning to buy TMO, so I'm looking at a number of options. My ideal options are deep in the money and far out in expiration date, but they're illiquid. There's no volume. But let's say I want to buy this one. What am I going to do here? That's a $60 bid-ask spread. Remember, we're always dealing with 100 pieces of stock for one option contract, so multiply by 100 at $59.999 is actually $60. It's $60 spread means that the midpoint is $30 above the bid and $30 below the ask, and you'll see that right here. So the midpoint is going to be 15.4. The last is what the option was purchased at or sold at previously. We don't really care about that. We care about the bid, and we care about the ask, and we care about the spread. Why is this important? Well, because you're going to lose money if you're not taking care about these issues. Why is that? That's because of something called slippage. I'll show you about slippage via example and why it becomes really important with option trading, especially when you're trading complex options. But for now, let's just say that this really only applies to illiquid options. When you're trading something like the SPY, the market order is good enough. Just because it's liquid and because that bid-ask spread is simply negligible. But when you're trading something like TMO, now you've got to worry about that bid-ask spread. Alright, so we're going to do a example of slippage in a minute, but I'd like to show you my entry strategy for a stock of any liquidity and any bid-ask spread at the moment. We're going to do this for a simple call option. Here's how you do it. Find the call option you want, look at the bid-ask spread. If you're buying, start from the bid. If you're selling, start from the ask. I'm going to use the buying example simply because it's easier and most people tend to buy options anyway. Let's assume we're going to deal with one contract for now. Last price is what it usually is entered in automatically in your trading program. And here's what you're going to do. We're going to enter the trade starting from 5 pennies or 10 pennies above the bid price. We're going to buy to open, and we're going to wait for that to fill. If it fills, congratulations, you've gotten an option way cheaper than the midpoint. But generally it won't fill that quickly. So instead what you're going to do is you're going to wait for it to fill, and if it doesn't fill, let's say in 5 minutes, you're going to cancel the order, come back, and raise it another 5 pennies or 10 pennies. And buy to open again. You're going to keep doing that until you get the order filled. I find that I usually get it a little bit below the midpoint. But sometimes you get it at the midpoint, and sometimes you're going to get above the midpoint, dependent on liquidity. I've found that this is the best way to open trades. Sometimes you're going to lose a bit of money because the stock will move against you, but that's just the nature of trading. So it's actually up to you whether you want to use this strategy to avoid slippage, or if you just don't want to care and, well, deal with slippage. Just take that as a natural loss. but I don't recommend it. And I'm going to show you why in this example. So let's say we're dealing with TMO, and we're going to be using multiple legs. Instead of just buying an option, we're going to buy an option and sell an option. And we're going to do 10 contracts this time. So we're going to sell a put via call. This is what is known as a risk reversal or a short combo. It mimics stock, but you get essentially you get to play the stock for free. Don't worry about the strategy just yet. Look specifically at what you have to deal with here, which is 2 bid-ask spreads. Now, in this example, let's say you don't get the best spread here, and you don't get the best spread here. You lose 5 pennies on this spread. You lose 5 pennies on that spread. 5 pennies is actually $5. That means for this spread plus this spread, you've lost $10. But you're dealing with 10 options. So you've already lost $100 as you enter the trade. And by lose, I mean you've paid more than what the midpoint was. So you bought it at a premium. You generally want to avoid that. It's going to be a bigger problem for you when you deal with less liquid options, and it's going to be a bigger problem when you deal with options that aren't expensive. Here we're dealing with a $300 stock, so it's not that big of a deal. But let's say you're going to trade something like Siri. For a $300 stock like TMO, or for something like SPY, you can buy one call option and make some good money simply from one option because of the price of that stock. If the stock moves 1% and is trading at $100, well, you've made $100. But if Siri moves 1% and is trading at $5, you've made almost nothing. If you're going to be trading Siri, you're usually buying many, many contracts. And if that slippage hurts you $5 per contract, you're buying 500 contracts, well, you've just lost $500. You bought at a $500 premium. That's why slippage is a big problem. Now, there are ways you can avoid this. And essentially, the best 3 ways are make sure you're trading something of high liquidity. That makes the bid-ask spread tighter. In many cases, you can just buy at the market price, and you don't have to worry about the bid-ask spread. Second, trade something with a high price. My rule of thumb is, well, it's subjective, but around the $20 to $30 area is the iffy area. That's where I question whether I should trade this at all. Just like liquidity, if I don't see a volume around 100 for the option I want to trade, sometimes I'll trade something that's 50 or more. That's the iffy area, 50 to 100. If I don't see a lot of volume, I will reconsider whether I want to trade it. Of course, if it's a really good trade, I'll deal with the slippage. I'll pay the premium for the option if I know that stock's going to move in a certain direction. But for most situations, I'm going to care about the liquidity of the option before I enter that trade. I'm also going to care about the price the underlying is trading at before I enter that trade. So the $20 to $30 price range is where I start to question it. Anything above $30, I feel pretty good. Usually I'm aiming for above $100 because I like big movements. Then third, you want a good entry strat. So maybe there's another strat that works for you, but for me, I don't mind if the stock moves that much because for most cases I'm not really day trading. I don't need those. I don't really care about these tiny candlesticks. I don't care if, let's say, my option doesn't get filled here and then I see a red candlestick. I'm not going to panic and raise my price. But if you're day trading, that might be important for you. My entry strategy works for me because I'm usually trading on the scale of like a week. But that's up to you. You still need a good entry strat. Because if you don't know how to enter and you're just setting at the midpoint, you're going to be losing money. A lot of people will just say, screw it, I'm going to just put the midpoint in because it's going to get my order filled. And that's okay, but I found in many, many cases you can get your order filled below the midpoint. You can save money that way. You can actually make money that way relative to what the actual cost is. Now, there's something I wanted to say about finding liquidity. And I really like this tool from NASDAQ. So I was just showing you everything in eTrade Pro, which is a tool I really like. But perhaps you don't have this. What you can do is you can go to nasdaq.com/symbol, put in whatever the symbol is, /option-chain/most active. Or you can just, get here by clicking. Click on most actives. It'll show you what the most active options in terms of volume are at the moment. This is really good for stocks that don't have a lot of liquidity. It'll show you what's tradable. So for me, I think these 4 are tradable, these 5 are tradable, and that gives me a pretty decent selection. So let's say I want to buy a call and sell a put. Well, I'll look at the combinations of these 4 calls and these 5 puts, and I'll figure out what I want to do. So this is a great tool. It also shows you the bid and ask. You can calculate the bid-ask spread by yourself. Usually it's better to calculate it by yourself because sometimes you'll be putting in trades that are quite complex, have many legs, and you'll find that the automated midpoints, sometimes they'll give you the midpoint. Automated midpoints are not that great, so you don't want to calculate it yourself. You're going to take the midpoint, and accumulate those. But this is a great tool for finding options when there's not a lot of liquidity, and it's also a good tool for seeing if something's tradable in terms of liquidity. If you have a tool like this and you go through, let's say, you just go through expiration date by expiration date, trying to find something, it's going to take you a while. I don't want to click through all these and look at the volume every time. I'd rather just go straight to this site and see the top volumes. So here, the best volume I'm going to get for calls is 40. Best volume I'm going to get for puts is 105. I mean, that tells me that if I want to buy calls, maybe I should reconsider. If I want to buy puts, I have a couple good options. And that's it for now. In sum, avoid slippage when trading options by choosing stocks with high liquidity, high price, and using a good entry strat.